All right, welcome to our Market of the Moment update for the week of September 26, 2022. Michael Oldham with the Oldham team here with Chris Madrid and Guaranteed Rate. What's up, Chris?
Hey, man, what's happening?
Anyway, let's jump into it today. Maybe that summary from last week's update, and some big things happened. And then we're going to look at our mortgage-backed security charts for the quarter and for this month. So let's start off with
rates, right? What everyone wants to know. I mean, what we're seeing in the market is on a 30-year fixed, you're looking at interest rates anywhere from 6.8 to 7%, possibly over, right? This is uncharted territory for mortgage companies and for lenders, and ultimately for investors. So we'll see here in a little bit on the charts. If you're looking at shorter term financing, like a 15-year fix, that is pushing low sixes now, right? 10-year, 15 years were in the 5% range for a long time. Now they're not. So now, the shorter term interest rates are pushing past 6%. So low sixes, 6.25 is probably where you're going to see like a 15-year fix if you were wanting to finance for a shorter period of time. So moving right on, go back one. Fed announced that they were increasing the federal funds rate. That was not a surprise to anyone, right? We fully expect them to go up by 75 basis points or 0.75%, and that's what they did. So that was no surprise there. That has now pushed the federal funds rate up to between 3 and 3.25. So there's not a set amount, but it's somewhere between 3 and 3.25 for the federal funds rate. Now, again, y'all, that doesn't apply to us, right? That has no bearing on mortgage rates, on car loans, credit cards, student loans, nothing like that. The federal funds rate does not dictate that. That is simply what banks lend to each other overnight. The prime rate, though, does apply to us, right? It's what your typical credit cards, equity loans, anything like that are based off of. Most lenders will take the federal funds rate plus some, right? And they will then plus a margin, essentially, which is what they're going to be making. Normally, it's for the prime rate, it's the Fed funds rate plus 3 for prime. So if you're wanting to know what the prime rate is today, is 6.25, because they're taking the higher number, the 3.25 plus 3. So not only do we talk about some stuff here, we also educate, right? So that's what we're trying to do. So you hear somebody talking about the prime rate, it's currently 6.25, because again, that's 3.25 plus 3. So, as we've been talking for, the last, I don't know how many months, inflation remains out of control, right? It's at this point, it's super elevated, out of control. We can all feel it when we go to the pumps, when we go to the grocery store. Man, I went to just to completely get off subject here, but I love that we have the flexibility to do this. I went to the grocery store to get some half and half, right? And your typical quarter jug, right, of not even a half gallon, like a quarter gallon, whatever it's called, like $6 for just your regular half and half. So I guess I'm gonna have to go to back to drinking coffee just without straight anything black in it, just straight black. Yeah. Anyway, so yeah, we fill it at the grocery stores. Although gas prices are slightly lower this week, we fill it everywhere, right? So if you're going out to eat, if you're going to the grocery store, man, if you're going to freaking Home Depot, right? Things are crazy. Yes. Anyway, so we're all feeling elevated inflation. Now, one of the somewhat positives, I guess, of the Fed meeting last week, as well, as they indicated, at least for the next handful of months, they will not be selling off mortgage-backed securities. So that it's kind of twofold. So they're not going to be selling them off, but then they're not going to be reinvesting, which is what they have been doing for the last 15 years. They were purchasing mortgage-backed securities, reinvesting. So again, that's what has kept interest rates artificially low, which we're most likely not going to see anymore, right? As we've talked in the past, in a typical healthy market, right, a healthy economy, mortgage rates are in the 6% range. So that's what a healthy market looks like from a rate perspective. And again, right now we're seeing we're seeing rates push up into the low to mid sevens, right?
Wow.
So you can go to that next screen, and we'll look at mortgage backed securities. And man, this week it has been a roller coaster ride with mortgage backed securities. So this is just a quick view from this month, right? So we started the month in above 100. So we're looking at that far left candlestick. Nah, it's okay. This is fine. I mean, we can work with this one. But this is your email, so but it's fine. We can talk about September. So this is the month of September. This is most recent information. Started the month over 100, right? So we see that far left little candlestick there, and we were over 100. Well, we can clearly see how this has deteriorated to this past week to Monday, which was like the 26th, 27th,
Yes.
where we lost, the friggin' bottom fell out, and we lost over 160 basis points. So if we look at that biggest candlestick right there on the right, we can see that started the day somewhere in the 97.5 range, right? And just, I mean, dropped below 97, obviously closer to about 96. So I think all in all it was 166 basis points.
Wow.
Something like that. So we've gained a little throughout the week, but we're still not. Yesterday was actually a pretty decent day. We had a couple of clients under contract with the Oldham team, got them locked in yesterday.
Yeah.
And then of course, mortgage backed securities this morning, we're down, we're at this point, we're down 41 basis points. We were down over 30 this morning. So yesterday was a great day to lock, which we advised all of our clients to do so. And we did, thankfully. They're in good shape. But man, there's we're starting to see these massive, these massive swings from day to day in rates, and in particular in the bond market.
Yeah. So if you're in the market right now, you need to be with someone like Chris that's watching this hourly. So just like if you were buying
minute by
a
minute,
stock,
baby. Minute by minute.
It's like if you were buying a stock and you wanted to get it low, you want to, get this interest rate when it ticks down at the right time. So having Chris in your corner, that's the way to do it. We need to go back and look at that other. Probably.
No, it's fine. We can skip past it. Yeah, because it's just going to show. It's just going to depress all of us to see where they were.
I'll
this
put
quarter
it up there to show how the third quarter.
Oh gosh.
We have just constantly ticked down. I remember when we were talking about this back in August.
I think you need to go to the other screen, by the way. You need to switch screens on your
back in Zoom. August, when we were talking about staying above, I believe it was that 102 mark.
Yeah.
And we haven't been above it in a while. So
all
right. Anything else to add?
Rates, trends, Fed review. I think we've covered it all. Man, so this is super interesting, right? And just a little soapbox. I was kind of just again looking at data, seeing the volatility in the market, right? And just something I was thinking about this morning, and I actually posted a video for all of my Instagram followers out there, right? All 5 of them. Just the thought of, right now, obviously rates are elevated. There's a lot of customers on the sidelines, right? And either they're renting or whatever it is that they don't want to purchase. And here's the crazy thing is that, again, with as much volatility that we're seeing in the market, this could push through the end of the year, beginning of next year, right? So what if you had an opportunity to purchase at 7%, let's just call it, right, a 7% interest rate, but you're not having to bid, you're not having to go 10, 15, 20% over list, you're not having to give all these concessions to get in a home. Yes, your interest rate temporarily is a little bit higher, but let's just say you decided to wait, and next year mortgage rates are at 10%. Right? That 7% doesn't look so bad.
Yeah. Definitely.
So that's again, the reality is 2% mortgages are gone, right? For a long time. This is my 20th year. And in 20 years, I hadn't seen 2% mortgages until the last, 2 or 3. And it's, it may be that amount of time before we see them again. So 6 to 8 is the norm in a typical economic environment, right? 6% to 8% is your normal mortgage rates. So yeah, don't buy into the doom and gloom. Purchase while you can. Well, I mean, the market's great right now for buyers. So
Exactly. And you sell and buy in the same market. If you're not selling, it's a great time to go to buy. We've been getting buyers under contract for 10, 15,000. One was 25,000 under list.
yeah,
Granted, you might have to sell your house for 10,000 under list. For our particular clients, we got them in a house for 25,000 under the list price. And they sold theirs for 10,000 under its list price. So in my eyes, they still came out $15,000 ahead on the situation.
yeah.
But